Awesome. Thanks. I'm excited to have you here, Danny. So I'll just go ahead and jump in. My name's Alicia. I am based in California, in the Bay Area. For the last 4 years, I've been working on African startup ecosystem development, which is really what prompted this webinar and kind of where I'm headed personally. I just think that there's not enough information on, well, first of all, there's not enough capital for African technology companies in general. And then there's just not enough information on what that fundraising process looks like, how to go about fundraising. And I think that what's exciting about venture capital is I think there's a lot of changes happening. I'm always posting about changes in SEC regulations or what's happening within like AngelList, I think is really active in being really creative in the funding space. But anyways, just my goal here really being twofold: to provide startups with a little bit more insight on how to navigate their fundraising process, and then also to help investors really think about how to think about the African opportunity. So kind of serving as this kind of middle woman for bridging access to capital. This webinar is particularly inspired, as Danny will probably see, by my experience at VU Venture Partners. I think a lot of what was learned in that 3 months really just informed, I think, some perspectives that investors would talk about. Oh, I'm looking for, a great team. I'm looking for the, product market fit. I'm looking for, some of these other kind of core parameters for venture capital. But I think what's not talked about is the back end of that. So it's like, how is venture capital even set up? And then that really helps startups understand, this is why we're looking for what we're looking for. And so I personally just had some big ahas during my time at VU, and wanted to share that with entrepreneurs. So I think I'll say a lot of this was targeted for entrepreneurs themselves, but I think that if you're wanting to just better understand venture capital, like, you'll get a good sense of what's at play. I think with that, I'll go ahead and just jump into, let me see if I can change the slide. So we did intros and a little welcome. I'm just going to start off with a little bit of understanding the VC risk appetite and why venture capital is so hard to get. I'll do a little venture capital one-on-one. So just kind of understanding who VCs are, what are they looking for? How does a fund actually get, operated? And then I think there's something that for me was a really big takeaway, which is why it's important to understand what a fund's investment strategy is. So again, this is through the lens of a startup, why you would want to know what the fund's investment strategy is. But then, of course, if you're more on the VC side, like, why it's important to think about how you're going to be deploying your capital. I have some questions to ask during your next call. These will probably be most relevant for entrepreneurs, but we'll open it up for Q&A at the end, assuming that we have some time. I'll go till 11. And so I think we'll have plenty of time to get through all of this. So I believe you all are unmuted. I'm going to go ahead and get started. Please feel free to either interrupt me or go ahead and throw questions in the chat, and we will take it from there. I'll try and answer as many questions as I can. Yeah, I think we should have a good time. Ooh, my next button doesn't work. So I've already kind of talked about the objective here. So again, this being more focused for entrepreneurs to help them understand how VCs think and operate, to help them navigate the fundraising process. And so again, if you're coming from a more VC lens, it'll be more about, fund VC operations and just general thinking. So I think, given who's in the audience, well, I'll go ahead and just pose this question anyways, right? Like, what is venture capital as an asset class? Like, what is it intended to achieve? And mostly because I'm just curious how you all think about what the venture capital asset is. And this can be verbal or through the chat. ROI for shareholders. Perfect. That's exactly it. And that's exactly where I'm headed with this. For venture capitalists, the ultimate goal is you've been able to get capital from LPs, and you're deploying that and making some kind of ROI on that. Again, for I think the entrepreneurs in the room, this may be a shift in perspective on what the lens for VCs is. Ultimately, what they're trying to do is put a number value on an entrepreneur's ability to execute profitably. So when you're thinking about pitching a VC, you're typically thinking about what is how much money, how the VC is typically thinking, how much money can I make from this opportunity? And the bet that I'm placing is, can this entrepreneur execute in a way that's going to generate sizable returns for our fund? The reason I start with this is because I think, again, for entrepreneurs, there's not really an understanding that that's the fundamental goal for venture capitalists. I think they're like, oh, if I have a good company, they'll invest in me and then like I can go and do my thing. But there's this kind of missed perspective of, hey, the goal here is actually to just get an ROI, right? VCs are essentially money managers. So when we look at this from the perspective of where VC falls in the scheme of risk profiles, you have kind of your lower risk, which is cash at the bank. So you have, very nominal risk as far as the likelihood of your money disappearing, to the return. So your interest rate is usually really low and you're kind of just coasting. And then as you kind of go up, you'll see I highlighted real estate, PE, and VC. For real estate, it's a little bit higher risk, but real estate has been so templated, and there's so much around where there's kind of so much already in place as far as the risk of what could potentially happen, that your return is really high. The likelihood of it kind of defaulting or not really working out is much lower. And so what we've seen is this ends up being anywhere from 3 to 5x as far as the amount of capital that you'll make on a particular real estate deal. So then as you get into PE, private equity, you're typically seeing anywhere from 1 to 3x return on your deals. But as you all probably already know, private equity is looking at deals that are pretty far along. I think in the African context, they're starting to move more into earlier stage deals. So it becomes a little bit more risky like a VC deal. But traditionally, private equity are companies that have been, that are more at the growth stage. So while the returns are pretty high, the risk is pretty low. And so they have a little bit more flexibility as far as the types of things that they're investing in. And then you have VC, which is like your most risky, right? Because it's a company that's not been validated. There really isn't any sense of, I guess the probability of the company failing is so high that it needs to be really, really profitable in order for you to invest in it. And so I think I want to land with that point, because ultimately, if you're a VC and you're going to invest in a VC deal, it needs to be, it needs to generate sizable returns. And so that's why venture capitalists are typically looking for a 10x return, because again, if you're thinking about this through the lens of a money manager, you could go into real estate and it's a 3 to 5x return pretty much guaranteed. And so you're better off actually investing in real estate deals than into a company that's not going to give you at least a 3 to 5x, but ideally, again, like a 10x return. So I present this as kind of a way to say, for venture capital, the reason that we see it being so difficult for startups to get is, say you're looking at a lifestyle business, and while they're, they have sustainable revenue, and they look like they're, just kind of a generally profitable or soon to be profitable company, if they're not getting into this range of 10x, then it really isn't a venture deal. And so for the entrepreneurs, it's, there's this kind of misunderstanding that venture capital is just the way that you finance a business. And what you'll come to understand is that like that's actually not the case. VC is not meant to be for every single company. So this is from Indie VC. I thought this was a really kind of poignant way of making the point. So you'll obviously see here, blue is companies that don't access venture capital, which is quite significant. Then you have pink, companies that access venture capital but don't reach venture scale. And so that's kind of tiny in comparison, just to give you some perspective. And then of course you have companies that are that reach $1 billion valuations. That's in black. The key point here is like, you don't even see them because they're so few and far between. And it kind of goes back to my earlier point that venture capitalists are not looking for lifestyle businesses. They're not looking for businesses that are like, just just kind of like could grow to be something that's big. Like they're looking for that $1 billion valuation, because again, and we'll get into this a little bit later, what you're ultimately looking for is that 10x return. And when you're managing a portfolio, you need all of your companies within that portfolio to at least give you that, given the rate of failure being so high. So I just threw a lot out there. How does that land with folks? Any questions? Does that all make sense? Awesome. Oop. Cool. So we'll dive a little bit into Venture Capital 101. This will give some perspective on, again, from a VC perspective, how you're going about building, I guess, essentially what that life cycle looks like, right? So just starting from the beginning, you'll essentially develop your thesis. And in this process, what you're doing is identifying, what types of businesses are you looking for? What is ultimately the industry or industries that you're trying to invest in? And how is it that by investing in those companies, you'll be able to make some sizable return for your LPs? Once you've really been able to develop that and create a clear kind of framework for what that looks like, you'll go out and pitch LPs themselves. And many of you may already be familiar with this, but essentially, if you're a fund manager, or if you're trying to raise a fund, you're pitching LPs in the same ways that VCs are pitching, the same way that startups are pitching VCs. So you have this, I would say, similar hustle happening on both ends. So once you've pitched your LPs, then you move into closing that fund. What's exciting that we'll see in the ecosystem now is we're seeing a lot of rolling funds. And what that essentially means is you're not necessarily needing to close the fund cycle. There are some challenges with that, but ultimately you can have a relationship with an LP, deploy, and say it's $1 million, you can deploy that capital, and they can kind of continue to just give you money so that you don't need to actually do another fundraise. The benefits of this is that it does create a little bit more accessibility for some fund managers, since they don't need to have a solid close on the funds, or people can kind of come in and it's kind of a come as you want feel. But again, there are some kind of management issues with that, just as far as like management fees and et cetera. But anyways, so in a traditional fund, you would close the fund, and then you would start selecting your startups and deploying capital according to your thesis and your strategy. And then as you continue to do that, you'll raise your second fund once you've deployed all that capital, and then move into more of a supporting role. So you're both raising your second fund, supporting your portfolio companies, and still focusing on deal flow. And so I think one of the things that's interesting that I think most people may not have insight into is that VCs tend to be very, I would say, packed as far as how much time they have in the day. Once you get to this stage, which is I'd say about a year or two into your fundraising process, or your, like, I would say, VC career, you have a lot of moving parts. You're managing your LP relationships, you're raising the fund, you're supporting portfolio companies, and so the day becomes very accelerated. And I would even liken it to being a startup founder. So again, just to give some perspective on like what's the grind like that's essentially what they're doing. And then you'll go on to deploy fund 2 according, again, to your investment strategy. And then, at some point you'll start to see who in your portfolio is doing well. You'll stop funding the companies that don't do well. You'll reinvest in the companies that are successful in order to maintain your percent ownership. And then, you're obviously like supporting the startups along the way, and then just waiting for that exit. So this, I think, is interesting. And again, this being, mostly from the perspective, or for the perspective of an entrepreneur, but I think can even be interesting for VCs is, who is even the VC, right? I think traditionally we saw a lot of bankers that were in this space. It predominantly bankers, and then former operators or former entrepreneurs that had a lot of capital. Essentially, they're people with money, or people that have access to a lot of money. It's exciting that we're seeing that change, but essentially you have, people that have either worked at a Twitter, at a Uber, have become an executive and want to go off and fundraise, support other entrepreneurs, people that have been entrepreneurs. So these people are usually at the partner level. It could also be somebody that has industry expertise. So, if you're a fund investing in some kind of health tech, you typically want someone, whether it's you yourself or one of the partners, to really be the expert in the field, so that as you're coming across opportunities, you really know, like, is this an opportunity, or, is someone making something up? And then, as I mentioned, someone with a finance background. So you'll typically find them I want to say more so now at the analyst and associate level. But again, because of how venture started, a lot of the, I would say, Sequoias of the world and older venture funds typically are people with a finance background, but they've been in the industry so long that they just understand, they've seen so many businesses come and go that they have really deep insight. The reason I call this out is, again, from an entrepreneur's perspective, it's just good to know who you're talking to. So are you talking to someone that's formerly been an operator? Are you talking to someone who is mostly coming from a finance background, which means, they're probably more looking at the numbers. They're probably thinking about this more from a market research and market analysis perspective. Everyone will be, but, it gives you some perspective on where to give weight to the conversation, and like how to really frame what you're doing and how you're doing it. This will probably be not news to anyone, but a VC's job is to do a couple of core things. One is to source your companies. That means you need a big network. Two is to pick the companies. So you'll also need a big network for that. And then portfolio management and adding value. So being valuable in some way to the portfolio companies. So I think for people that are trying to get into VC, one of the things that I've heard the most in conversations through VU was, it's less about your technical chops, as far as like finance and doing financial modeling. And it's really like, can you find really interesting proprietary deals? Can you find, can you support companies, right? Like, what is it about your experience, your background, that really will add value to a portfolio? Because what we'll get into later is there's really not a lot of money in venture, and you're not often going to be able to join it as an employee, which I think it becomes interesting, because that's a lot of the conversation in venture now, is like how to get more, how to, find jobs in VC. You find that they're very limited. And the reason being is something that we'll get into a little bit later, but just to provide that perspective of like, since there are so few, seats at the VC table, like what's really that edge that you'll give the portfolio, so that it's like, we have to have you on board. And then lastly, the VC's job is to keep LPs informed. So a big part of the scope of work, like I mentioned earlier, is letting LPs know, like, hey, this is an opportunity that we're considering investing in. Here's why we think it fits within our thesis. Let's go ahead. We're going to make this investment, not necessarily getting their sign off, but just kind of keeping them in the loop about the opportunity. If they want to offer some input, they can. Sometimes LPs want to invest in the company directly, so they'll invest alongside the fund. And essentially just, allowing them to make even more money. And something that I thought that was really, really interesting about venture capital is that VCs aren't particularly rich. And I think there's two sides to this coin. One is you do have to be wealthy or have some kind of money to be a VC. And that's because you're not actually making a lot of money in your first 2 years as a VC. Because management fees, especially, if you have a smaller fund, are not really that high, which then makes sense, right? Why so few from underrepresented demographics are actually in the venture capital space. It's like, you really do need to have a safety net of 2 years to really be able to manage the fund. But you're only really making money once the fund does well. And so if you are, I would say that there's a lot of like appeal to being a VC, because it's kind of the hot thing to do right now. But if you're really going into it to like, because you're like, I want to make money, it's a long game, essentially. And so you're better off kind of like starting a business or either like a lifestyle business or even trying to just have equity within a business that you're running or you co-found, because it's not like a get rich quick game. This was a surprise to me and made me actually even rethink, like, do I want to do VC? Because I actually would like to make some money. So that's a little bit about who the VC is. I will just pause there real quick to get a feel for the room. How's any questions there? Any insights, observations? Awesome. Then I will chug along. So many of you are probably already familiar with this, but raising a venture fund is, like I mentioned earlier as well, very similar to the to what a startup's process is for raising capital. So limited partners are essentially evaluating general partners or the fund managers on a couple of things. One is like, what's your thesis? So why do you think that this is a really lucrative opportunity that if I give you my money, I'm going to get sizable returns? And then stage focus, so really being clear about why you're investing either at the Series A or at the pre-seed or at the Series B or C, whatever kind of, depending on the fund you're raising. And then target returns and ownership. I think this for me was surprising because venture capitalists really need to be able to paint this picture of, if I invest in X, the expectation is that this will kind of break down to be, these number of companies will likely fail. These number of companies will probably do like a 1x return. And then these are going to, there's probably going to be at least one or two that are my big winners that return the fund. And so they really need to be that clear in saying, like, this is how I see me being able to return your money to the fund. And so really painting out that picture, again, a lot of that coming into the thesis and the stage focus, and actually a lot of also the investment strategy, but essentially just painting the picture for the LP on how the money will be deployed and then how the money will be remade. And then amount raising, of course, is, are you raising a $10 million fund? Are you raising a $5 million fund? And then, of course, the why behind that. So that's essentially what limited partners are looking for. I mean, I think all of this comes with a grain of salt. A lot of this is the network game. Who do you know? And so I think for new fund managers, you're really having to build and nurture those relationships, because I've been doing some like due diligence for a fund based out of South Africa that's trying to raise capital. And you'll find that a lot of the cold calls, and again, if you're talking about Africa as well, like there's a lot of just general education that has to happen. So building a really strong team goes a long way, because it at least provides the LPs with some confidence that, one, you guys are smart, and two, that based on what you're saying, you can execute, or you have a proven track record of executing. So I guess that takes us to the other side, where general partners must prove, team, as I just mentioned, that you have proprietary deal flow. So why is it that if I give you money, you'll be able to find really unique deals? And, track record of success, whether that's with having worked with companies in the past and helping them, reach certain KPIs or milestones. If you've invested as an angel investor and have seen an exit or seen an M&A, but really just like, what have you done in the past that will prove your success? So in a lot of the conversations that I've had, if you're trying to get into VC, like, it's really just been go do it. Like, that's kind of the feedback, is just like, go ahead and just act like you're raising a fund, and find some funds that you can like facilitate some introductions to, and just build and nurture those relationships. There was actually one person that I spoke with who was saying that was how they ended up getting a job, is they just kind of were consistent about providing deal flow to a particular fund. And once that fund raised their next round, they were like, hey, you've been giving us some really high quality deals. Why don't you come and join our fund? So just to give some perspective on what that process looks like. Oh, looks like something came in. You mentioned reinvest at one of the stages in a VC's life cycle. Does that capital come from the same LPs or funders? Toby, that's a great question. It depends. I think so what's interesting about venture capital as well is because you won't necessarily see a return in, how did I get lost? Because you won't necessarily see a return for 7 to 10 years, or when companies exit, you don't really know if your thesis is actually strong. So I think a lot of it comes down to, like, were you able to maintain the relationship with your LPs? Do they feel confident in your ability to continue to find good deals? Have you had a couple of early successes so they're excited about working with you? I think that becomes part of it. And then again, if you decide to even shift your investment strategy where you're like, yeah, for my first fund, I wanted to do investments in, at the seed stage. And then for maybe my second fund, I don't want to actually invest in any new deals. I just want to do follow-on rounds for the companies that I've already invested in. That might kind of influence if you're going to the same LPs or new LPs. So it really depends on your strategy. I think, again, if you've raised $5 million the first time and then want to go on to raise a $20 million fund or a $50 million fund, you may need to bring new LPs on board. But then, of course, you can just point to your success in the first fund as kind of like, here's why you should invest in this. So it kind of depends, but you see both. Oop. So this is just to give you guys some perspective. This is from Harlem Capital. This is a slide from their deck that they were using to raise capital, and I really just pull this up to show, like, the level of detail that people are going to, or that fund managers are going to make clear, like, why they're a good potential fit, right? So here they kind of outline how much they've done in their first close, how much they have committed, what their goals are, or how much they've gotten from different LPs, how much they've been able to get, how much of the capital they've been able to call in, what their outlook is. And again, this is like one slide in about a 25 slide deck. So it really is a lot of thinking through what that investment strategy will look like, and again, why you'll make the LP's money that goes into the process. So I think from an investor side, a lot of this is like, fantastic. This gives some perspective on the amount of work and what's required to raise a fund. And then I think on the entrepreneur side, what it does is give some perspective on how much is actually working in the background, so that when investors are like, yeah, we're interested, but like, we're not going to invest, it gives some perspective on, I guess, like, beyond just the fit for the company, like whether or not the company's a fit, but like why they may or may not actually invest or engage. So I think ultimately, like, there's a lot of mismatching, and entrepreneurs often don't have this perspective of like what VCs are going through and how they have to think about deploying their capital. That gets lost. So a lot of this I've spoken to already, but I think what I'll call out, just as far as like what a day in the life of a VC is, you've raised your capital, you're doing deal sourcing, and then you're getting into the due diligence, right? And so you're starting to look at, is this, maybe you see a company that you like, you're like, if I do the research myself, does this opportunity really seem as lucrative? They're saying that this is a $20 billion market, but my research says this is actually only a $6 billion market, and there's already like lots of competitors in this space. So you really start doing some of that analysis. In addition to that, you're then actually deploying the capital, you're managing the portfolio, you're doing the LP reporting, and you're harvesting. So a lot of this, again, I kind of talked to in the timeline, but two things I want to call out here that I think are interesting. It goes back to my earlier point in the beginning, where you can think of a VC as like as a recruiter, and the amount of time that they're spending on a deck is heavily reduced. And Danny, I'd actually be curious if you've been having this experience, but the number of pitch decks that come in through my LinkedIn are just so many, and some of them aren't good fits. So I'll kind of say, for people that I know, I'm like, here, somebody reached out to me, here's a deck, do you want to take a look at it? But honestly, it becomes a little bit overwhelming, the amount of, it speaks to the challenge in the ecosystem, right? Like, there's just not enough capital to get some of these early companies off the ground, which is why I think is exciting that you see more investors being accepting to crowdfunding. Exactly. So yeah, there's this constant inflow of of need for capital. So yeah, I guess to take a step back of what I was saying is, one, it just speaks to the fact that there isn't enough diverse capital out there to, and diverse in that is meaning like the types of capital for all of the entrepreneurs. And then the other side of it being, investors are overwhelmed. I'll show you an image later, but essentially you have, for a $10 million fund, you probably have 2 partners and maybe an analyst, probably more likely to have 3 interns. So these are super, super small teams. And they're getting flooded with requests for capital. And so the VC's mindset around that is like, let's kill deals fast. And what I mean by that is, how do we get to a no on a deal as soon as possible? So if I'm looking at a deck and I'm like, oh, this looks interesting, like I'm looking for the thing that's going to make me say no so that I can move on to the next thing. And so it's an unfortunate, I think, part of the way that you see VCs work, but it really just speaks to, again, I think just the lack of earlier capital. And then also I think education for, if entrepreneurs were a little bit more informed on the amount of due diligence they should do before reaching out to an investor, instead of just kind of like a spray and pray approach, I think you would likely see some shifts. So yeah, I think just kind of to highlight how intensive I think the process ends up being for VCs, and not to I think give them more credit than is worth, because I think at the end of the day also what you see is just a lot of groupthink. So what I mean by that is investors will kind of like look at a company and kind of like, oh, but who else is investing, and kind of wait to see who else is on board. A lot of VCs are just waiting to co-invest with some of the biggest names. So there's really not a lot of individual thinking that happens. And so I think if you're anyone that's like looking to raise a fund, I think the biggest competitive advantage, or one of the biggest competitive advantages you can have, is just like really thinking for yourself and investing in companies that, like, once you've done the research and kind of see an opportunity, you're like, I don't really care who else is investing. I see the opportunity and I have conviction around this. Because like I said, VC is such a small network. Everyone knows everyone. You say something about something, if an entrepreneur says something about an investor, that investor will turn around and say like, hey, I just had a call with XYZ. Are you actually going to invest? And they'll be like, no, that's not what I said. So it just meaning to say it's a small network. There's a lot of work that's going on the back end, but ultimately they're trying to get through as many deals as possible to really find the biggest and best opportunity, which again, unfortunately leaves a lot of entrepreneurs kind of hanging. So how do VCs add value? There's 3 core things that I think as a VC, you're kind of expected to be able to offer. And then, if you're trying to get into VC, it's good to start building around. And then if you're an entrepreneur, what you can expect from a VC. The first being kind of strategy and benchmarking. Despite all of the runaround, they do make some time to do some of the research and due diligence around an opportunity in the space. And so actually, I think one of the things that's most interesting to me is, for venture capitalists, what you're finding, you're seeing so many deals. And so a lot of times your investment strategy is literally, okay, I've seen all of the deals in a particular industry. And so even just like, for example, from my experience at VU, we were doing robotic kitchen companies. And the partner was like, yeah, the way that we approached this was we just looked at all of the companies operating in the space, and we found the best one. We found the one that we thought was doing the best and doing the best work and had the most kind of innovative approach, and had the most potential for scale. And so we invested in that one. And so, but you're seeing so many deals that you can kind of see like, oh, that's actually not going to work. I can see why they're going this route, but still that's a little bit off. And then get to a point where you're like, wow, I really found the company that I think is doing this well. We'll make that investment. So it becomes like unintentional market research, but market research nonetheless. Like you're still learning a lot in the process. And then of course you're doing actual real due diligence. So once you start peeling back the layers of understanding what the market opportunity is and who are the actual customers and talking to other investors and potential customers, you really start to build strong understandings of the market that then once you have a portfolio company, you can kind of offer that insight. But I don't know if any of you all are on VC Twitter, but VCs get a bad rep for kind of being experts without actually doing anything. And I think a lot of it really comes from this process of like, we've done a lot of the research, but like, we actually haven't done anything in the space. Exactly. Yeah, the VC brags. I try to stay in the loop on VC Twitter, and I also try not to, just for my own sanity. So anyways, strategy and benchmarking being a big part, and just being able to offer some perspective from the things that you've seen. Network being a huge part of this. So being able to provide introductions to customers, to potential talent to join the team, especially as, if you're deploying capital, that means they can grow their team. And so like, can you get them access to that talent? And then partners, right? Like anyone that they can do strategic partnerships with, anyone that can, maybe even like be a potential acquisition. So really just having a strong grasp of the business ecosystem around them. And you're essentially just like pouring these resources to them. And then access to more capital. So that being either follow-on capital, bridge rounds. And like I said earlier, the investor network is so small that you likely know who would be a good follow-on. You probably, as an investor, have already shared the deck with a potential VC and been like, hey, we invested in them. We'll likely, this may be a good fit for your fund, once they're raising their next round. So there's a lot of that happening within the ecosystem. But really, it comes down to these three things. And I think what you may or may not find surprising is there's not really anything technical here. And there's not really anything, I think, that anyone that just put in the work couldn't do. So again, back to like the advice that I had received, which is like, kind of, if you want to do VC, just go do it. It really just, I think that the barriers to VC are really more just about how it historically was made than anything else. Having an MBA, I think having a financial background is helpful. Even during my time at VU, there were some people on the team, Danny, you'll remember Arpin, that are just like wizards at financial modeling. And then, when you do that, you're like, oh, wow, it's really easy to see that like the entrepreneur's numbers are not accurate. Like once you've done your own kind of due diligence, but besides that, yeah, I would say that the barriers are really more about historical structures and people knowing people in the network and having access that way. So just a little bit about how VCs get paid. I spoke about this a little bit, but I think it just gives some perspective that if you have a $10 million fund, you're looking at, management fees are typically 2%. And that's what you as the partners get for running the fund. So, we can just pretend myself and Danny started a fund. It's $10 million. We have about $60,000 in operating expenses. Between the two of us, we're getting about a $70,000 salary. So it's like, you could go get a job in tech and make $150,000 with your technical background, or you can make $70,000 as a VC, with the hopes though that you will, have some kind of exit and make massive money on the back end. But again, it's all about just like the risk associated. As you go down, you'll see that like, oh, these numbers start to get really big on the salary side, but you'll see that like, that's just for the number of partners. You're also then hiring associates, senior associates, bringing on interns. You have a bigger operations team to manage investor relations, to manage, you start getting a little bit, the team starts to get really big. So the salaries themselves end up being really low. So I think this just goes back to the fact that like, if you're in VC or interested in VC for like making the money, yeah, it's a long game. It's a long strategy or long-term strategy. And then I think what's interesting about this too is if the management fee is not kind of like, thanks for managing my money, we'll make money back on whatever returns we get. The LPs are like, so also you owe me back my management fee. So all of this is really not even yours, right? Yours as a VC. This is essentially a loan to do what you're doing, and then you have to give that back with the returns. And I think this next slide actually paints that picture. So if we go with this example of a $10 million fund, and you have a 3x return on your fund, so you've made a total of $30 million, that full 10 million goes back to your LPs, and then that leaves you with 20 million left over. And one thing that was surprising to me is that the distribution of earnings is actually 80% back to the LPs. So of that 20 million, they're getting 16 million back. And then 20% goes to GPs. So that's about 4 million. And then that gets split between the partners. That looks fantastic. I would not turn away $2 million, but it is fascinating that, that $16 million goes back to LPs. And then it kind of just paints this picture of like, what's the cycle of capital? And it's like, for people that have money, you're just investing and then you're making even more money. And you can kind of just see this capital concentration, which I think is really, really fascinating. So we're pretty much at time, we're getting there. I think I'm going to go ahead and just pause here, and maybe I'll just make my point really quickly on this. But again, this is kind of like double clicking on investment strategy. One of the things that's really important for, again, entrepreneurs to know is how the fund is, what the strategy is. And it's important for reasons that I kind of got to a little bit earlier, but essentially, if you have fund A, which has no follow-on strategy, you might invest $10 million in 100 companies and you're like, that's it, that's what I'm doing. Don't come back to me for, asking for follow-on capital. I might be able to provide intros, but I'm not going to, as the fund, provide more follow-on. It's a potentially good strategy because you can put more money into more companies, but you're not getting any significant ownership of those companies as they go on to raise more capital. So they're continually getting diluted. But again, like the pro being, you're casting a wide net. From an entrepreneur side, again, it's just good to know, can I expect follow-on capital from you? You may or may not want to go down that path. Sometimes you're just like, I need the money, I don't really care. But on the other end of that, you have what could be a follow-on strategy. And so you're like, I'll invest, I'll invest 100K in 10 companies. And then for the 5 that die, for the other 5, I'll invest a 500K check. And you can kind of continue to maintain or grow your ownership in the company, which then I think from a VC perspective really just paints this picture of the fact that you're ultimately looking for the most ownership of a company as possible. And so for the companies that aren't doing well, you're really less concerned about because you're like, look, you're not making me money, so it's neither here nor there. And so I think this is important to call out for the perspective of the entrepreneur. Looks like Lindy has to jump off. See you later. Thanks for joining. For the perspective of the entrepreneur, essentially, they should have some perspective on how the fund is investing, so that they can understand where the investor's placing kind of the most priority. But I think the big picture here being, investors are ultimately looking for the biggest return possible, and maintaining ownership in the successful companies. Because again, if you're only investing in 10 companies, be it you're only investing in 10 companies at an early stage and going to do follow-on funding, you need those 10 companies to either provide 30% to 100% of your fund. If you're going the other route, it's kind of less important. But again, at the end of the day, you as an entrepreneur will want to know, like, how is the investor thinking about the way that they're deploying their capital? Let's see, we're at 11. So I'm going to pause here. I think it's a good place to stop because really what I had left was good questions to ask. And again, these were mostly um, for entrepreneurs. So I think if you have a few minutes and want to ask a few questions, I'm happy to answer them. Otherwise, we'll go ahead and wrap up. But if you enjoy this, I'd love to know if there's anything else that you're like, this was super helpful. I would love to deep dive on something else. Absolutely do that. I'm thinking of doing a part 2 to this on startup selection, investor decision-making, and understanding terms. Follow us on Instagram and YouTube. I haven't actually quite set that up yet, but it's in the works. So stay tuned for that. And then if you know entrepreneurs that are like, hey, we need help kind of navigating, I'd be happy to speak or help support with that. Again, really my focus is on helping bridging this funding gap. And actually it's super exciting to have Io on the call because I think a lot of his work is going to be doing that in creating the kind of this Crunchbase platform for African technology companies. So, I mean, I think it's just exciting to have someone on the call that's like really laying a lot of the groundwork. But ultimately, I think you do need also people that can help kind of talk through the process. So all of that to say, if you're working with any African technology companies or working with any investors that are interested in looking at African opportunities, please keep me in mind. And yeah, I think with that, I will pause and hopefully you all can be unmuted. If you have questions, happy to answer them. Otherwise, thank you all for coming. And yeah, hope you enjoyed it. I'm just asking to unmute if anybody did want to have a follow-up convo. Thank you all who are responding in the chat. Yes, Io, unmute.
Yeah, so thanks a lot, Alicia, for the presentation.
Yeah.
I have a question. So, as I said earlier, we were founded June, and then we started talking to some investors, and we have two that we're talking to. One is very, very keen on the finance part, just as you said. And then one has been an operator. He founded a startup, sold it, and all that. So, how do you, as a founder, right? How do you choose? Because both of them are very much interested, but we don't know how to choose through. How do you balance your perspective? Because I have to say the truth, we're leaning towards the operator, but at the same time, we don't know if we're making the best decision. So how do you, as a founder, how do you like keep the conversation going, and at the same time you try to make the best decision? Thank you.
Good question. So, and just so that I understood the question correctly, what you're saying that there's one VC that has an operator background, and then there's another VC. What was kind of their value proposition? Oh man, did it not let you? Yes. Okay. So I guess it goes down to a couple of things. I guess my first question would be, could you take both? And the reason I'm asking that is like, are you in a position where you actually need to decide between the two? Could you take on that much capital if you needed it? I think that's one thing. If you're in a position where you have to decide between the two, then I would say, ultimately, what are you getting? What do you need the capital for? Are you getting it, if you were a hardware company and you're like, I need this to support inventory or to build out my SaaS platform or to support with product development, then you might want to go like a strategic route that can either help support with some of those things or just kind of like kind of hands-off capital because you're like, I know what I need to do. So I will just take the money and go and do it. If it's a different perspective where you're like, I need this capital because I need to bring someone on board that either has international relationships, somebody that can help guide me go from a staff of 5 to 25, and has experience with scaling companies, then you're really looking more at that like strategic capital side of things. And then what that'll mean for you is just kind of like, okay, where am I in my development? What do I actually need in addition to capital, and who can give me that the most? And not only like what can they give you in the immediate term, but then as you're scaling, who's potentially in a better position to facilitate introductions to other, again, customers or partners or other investors. So again, I think the question would just come down to like, what's the ultimate goal for you all? And then do either of them or do both of them offer that to you? And then so that's one part. The other part to that is, I would say, what are the terms? Because you, again, depending on if they're investors based on the continent or investors based abroad, they might be thinking about the opportunity differently. I've seen some interesting deals on the continent where they're asking for way more equity than is worth it. So, looking for maybe a more sophisticated investor that really understands that this is about helping you grow, and in addition to the fact that they're looking for a return, I think is another big thing to look out for. So that would be my high level answer, but feel free to add some additional color if you'd like. Awesome. Omar and who, sorry, I can't see your name. Yeah, any other questions I can help answer? Oh, and if this is a muted thing. Charang, awesome. I hope you enjoyed. Thank you for joining.
Thank you. I'm going to reach out to you for the free consultation.
Perfect. Happy to chat then. Will do.
Thanks. No questions. It was very, very useful, Alicia.
Awesome. Glad you enjoyed it, Omar.
Yeah.
We'll keep in touch.
Yeah. Let's keep in touch.
Bye.
Okay. Bye.
That sounds good, Ayo. We'll talk soon. Take care.